started talking about moving average convergence and divergence, or better known as MACD. Now, MACD is one of my favorite technical indicators. It's developed by Gerald Arpel in the late 70s, and it works for forex, all types of CFD trading. It even works for cryptocurrency. It works for stocks. It works for ETFs. It works for options, and it works in short time frames as well as longer term time frames, which makes it perfect for us because most of us, well, we're all ETX members, so that means we're trading CFDs in a very short term time range. And many indicators that people use don't realize that they don't work very well in 15-minute or 30-minute time frames, where MACD works extremely well in these tight time ranges. And MACD gives us three different types of information. It tells us about divergence. It'll give us entry and exit points, as well as telling us if the market is overbought or oversold. Now, the MACD indicator is typically placed at the bottom of your screen, of your trading chart, underneath the actual price action. Now, MACD, or moving average divergence and convergence, is a four-step derivative. The formulas are very, very easy. You'll never have to calculate them because it's automatically dropped on your chart. But you have to learn what makes up this crucial tool. So we're going to go through it step by step tonight. And after tonight, you just click on the MACD button and it'll put it on your charts. But you need to know what makes up MACD, so that way you understand when it's giving you false signals and good signals. So let's go over to the charts and let's take a look at my standard teaching chart. This is the Euro US dollar chart, live chart from right now. We're looking at a 30-minute chart and we're using Japanese candlesticks. I haven't picked this asset for any other reason except the Euro US dollar is the most widely traded asset, and this is my standard chart that I use for class. Because I'm not giving you a personal recommendation. We're not going to be talking about whether the euro is going to go up or down in reality. We're only talking about how to put the indicator on it. So MACD starts out just like its namesake, by using moving averages. MACD starts out with a 12-period EMA. 12-period EMA moving average. And as you see, I've dropped it on the chart right now, and that's the gold line going across your chart. So it's a moving average. It's the first part, the first line that we're going to use to build MACD. MACD then uses a second moving average, and it uses an EMA, an exponential moving average. And if you don't know about the different types of moving averages, you should come to our class on moving averages. But an EMA gives more weight to the most current price segment, and it's a little bit more accurate than a SMA, a simple moving average. So now we're going to drop on our chart a 26-period moving average. That's the blue line that I just put on your charts. Now, you say, why 12 and 26? I can't tell you why 12 and 26, to be honest with you. Except Gerald Arpel developed his indicator using a 12 and a 26 time frame. He's tested it over years. It's been tested for now over 50 years. Now, there are people who customize it, shift it, make it a 10 and a 20, make it the trigger line at 10 period. Once you do that, it's no longer really MACD because it doesn't hold true to all the things you learned. It's now Barry's MACD, and then Barry has to backtest it and understand it and interpret it because it's no longer the standard interpretations. I don't ever customize an indicator because I don't want to spend the time backtesting and make sure it works right in all markets and everything else. I use the way they were developed, but it's up to you. But that's why we're using a 12 and a 26 moving average, and we use the close period of the moving average. Now, if we were just to use these two moving averages, we'd be just trading a simple moving average crossover strategy, which is one of the simplest strategies in the market. It's fairly reliable, but it's a real basic strategy. When one moving average crosses the other moving average, it gives you buy and sell signals. But this is a basic moving average crossover. I use moving average crossovers often. I'll use a 10, a 20, and a 30, or sometimes I use a 30, 60, 90, because I use them for different types of trading, but it's still a very simple, basic strategy. MACD starts here and goes several steps farther to extrapolate this more accurately and give you a better piece of information. So the next thing that MACD does is it takes the difference between the 12 period and the 26 period moving average. Now, real quickly, if you don't understand moving averages, like I said, you need to come to our class on moving averages. But whenever you're using multiple moving averages, the one with the shorter period time frame is referred to as the faster moving average. This happens because it reacts faster to the price, because the longer you're at the moving averages, and then, so we're going back 12 time periods, it's only using the last 12. We're going back 26 periods, it's going back 26. So when you divide it and average it out, the shorter period reacts faster to shifts in price. So whether you're using this strategy or anything else, the shorter period is always referred to as the faster, and the longer period is always referred to as the slower. So in this case, we're going to take the faster moving average, which is the 12 period moving average, and subtract from that the 26 period moving average. All we're doing is getting the difference between this line and this line. Okay? So here, where we would take the blue line, which is the 12 period, and subtract from it the 26 period, we would get a positive number. Here we would take the gold line, which is the faster moving average, and subtract the blue line, which is larger, and we would get a negative number. We take those differences, whatever the number is, and we plot it below. So what we do is down here is we draw a zero line, and we plot the differences between the two moving averages. Whenever the moving average, the difference, touches or falls below or goes above the zero line, what do you know? You know instantly that the two lines cross, because when the two lines cross, they're both the same number, and therefore subtracting one number from the exact same number always will give you zero. Now we take the difference of these two lines and we plot it below, and it's called the MACD line. And this is the blue line I just put on the bottom of the chart. And as you can see, this blue line, when it crosses above or below the zero line, it's equal to the difference between these two lines above or at the zero. When it falls below the zero line, you're usually moving in a downtrend, and what's happening is your shorter moving average is less than your longer moving average. And you can see how it moves almost with price, not exactly the same, but almost with price. So all we've done here is we've taken two moving averages, subtracting from one another, and put them below. But again, if we were to use this, we would simply be trading a moving average crossover strategy. So our pal took it another step, and what he does is he takes a 9-period moving average of this, the difference, this signal on this MACD line, takes a 9-period moving average and then plots that as a separate line on the bottom of the chart. And this 9-period moving average is called the trigger line or the signal line. So now I put that below on the chart below. At this point, we no longer need to see these two moving averages on the price chart, because they're already calculated into here because you don't put MACD on top of the charts, and you don't have to do any calculations because the computer does it for you. So now we have the MACD line, which is the blue line, and the MACD signal or trigger line, which is the gold line. Now, again, we still have our zero line. That's here. Okay, so we have our zero line running right across at the blue line. So whenever these two lines cross each other and they're equal, they would be at the zero line. And when they cross above and below and they cross each other, they give us buy and sell signals. When they cross the blue line, it's also giving us directional clues and momentum. So when we see the crossover down here, this is giving us a sell signal. When we see the crossover here, it's giving us a buy signal. So whenever we have a cross, and if the blue line, that's the MACD line, is crossing above, over and above the signal line, it's giving us a buy signal. If it crosses over and below the opposite direction, it's giving us a sell signal. Now, this is the first step. It's only giving us transaction signals. Now, MACD gives us very reliable signals, except MACD does not take into any consideration at all how far an asset might move. It's telling you have a buy or sell opportunity, but MACD doesn't tell you it's going to drop 10 points, 20 points, 30 points. So you have to be very careful when using MACD because it's not giving you false signals. It's giving you, it might give you signals where you could make no money or lose a little bit of money, because MACD doesn't take into account the spread. It doesn't take into account exactly when you get in the market. It's telling you, okay, you have a buy opportunity. So like you see here, we get the crossover, but the market did shift upward, but not enough for you to make any profit. So you have to be very careful. You have to use other pieces of information when using MACD transaction signals. Now, the buy and sell transaction signals are, in a good strategy, the only beginning of a filter system, because a strategy is simply a filtration system to come up with only the best trade. So you have something that's told you have a buy opportunity or sell opportunity. Now you have to put it through a set of filters of other types of, decision-making tools to decide whether it's going to give you, if you would buy or sell. All you got was a heads up, because you need to filter out this trade, and you need to filter out the trading scenario or the trading opportunity, because what you want is a system that will throw out most of these opportunities and only leave you with the best possible high probability success trades. And then from there, you want to still have to put it in your risk management apparatus to make sure that you can afford to cover the swing of the market, the stop loss to take profit, whether your target point gives you enough profit over a possible, what your exposure is. So you have to do all of that. But MACD is a good starting point. But MACD doesn't finish here. What MACD does at this point is it goes one step farther. We take the difference between the signal line, the MACD line, and the signal line, and we subtract the signal line, the MACD line, from the signal line. And that gives us a numeric value also above or below 0. We then plot these onto the MACD chart using what's called a histogram. Now this histogram takes into its calculation the difference between the MACD line and the signal line, the depth of that difference, and tells us what we can expect. So when we have the MACD and the signal line crossing each other, like we do here, the histogram will always be at 0. If the MACD line is moving above the signal line, in other words, giving you a buy opportunity, you can see it grow here. But if you notice here, see, this is what you don't see. You don't have really a trading opportunity. Didn't move much. Same thing here, same thing here. This mountain or this peak monitors the depth of the movement or the momentum of the movement of that asset. So you have the crossovers to give you transaction signals. You have the overbought and oversold indicators when the MACD line pulls radically away from the signal line or forms a very high peak or a very low valley. It's telling you that that asset is overbought or oversold. So when you see the peak come all the way down steeply and then starts turning back in, it's telling you that market in this case is oversold. Here we get it's overbought. But when you get shallow ones, you really didn't have any trend or movement in the least. So this is how we put MACD on a chart. Now, depending on how much time you want to spend mastering MACD, and it doesn't take a great deal of time. Traders like myself, we don't use the lines on MACD at all. Once we put MACD on a chart, we get rid of the MACD signal line and the MACD line, and we simply use the histogram. Because everything you need to know and do is easily to see visually by using the histogram. Okay. We see the depth of the move. We see when it becomes overbought and oversold. The only thing we can't see directly from here is possibly divergence. Now, divergence is when the histogram or the MACD line is moving in the opposite direction than the price. But divergence is a tricky thing. Divergence warned you about something, but divergence can continue on, and divergence doesn't tell you to do anything. So when you see divergence and you get a crossover, that's a very good thing, because the crossover is what tells you what's going on, not the divergence. But like here, we can see the MACD line moving in an uptrend, where we see price generally moving in a downtrend. There's not an easier one to show you tonight on this particular chart, because there really isn't much divergence on here. But we'll talk about divergence a little bit more at the end. Because divergence does give you a big clue that there's something not right. So let's go back to my power. Now we have everything on our charts. We've done everything. Good. Now you got MACD on your chart. You understand what all the lines are. Now you have to figure out how to use it and what it's good for. So let's go back to my PowerPoint. And I've got a little presentation ready for you. We're going to talk about how to use MACD.
How fast the indicator is going to react to price change. Most of us will probably be chopped to pieces if we rely on only a short-term trading indicator as the basis for any trading system. The MACD line is faster than the signal line, and it's the reason we use the line as a proxy for momentum. But to make it simpler, think of it as measuring the rate of change of price. The signal line in the MACD is slower due to its setting, and traders are often use that as a trend determination tool, either using multiple time frames or just one trading chart. And knowing that we measure trend and momentum, you may already see how we can use the MACD to actually trade with when we use both the MACD line and the signal line to alert us to possible changes in the market. The two-line cross can be a powerful indicator of trading potential in the market. Here, we've set up the indicator on our chart. We use the settings as here, and we're going to read the MACD. When we want to determine trend direction via the MACD, we can look at where the MACD line is in relation to the signal line. The MACD line is below, between the red lines on the chart, we're looking for a short trade. If we see the market in an uptrend, and you'd be bullish on any trading setup. And as mentioned, we're really looking at the rate of change of price. So even though the lines are crossed, price may be compressed. This is one reason that multiple time frame trading is suitable for this trading indicator. You simply look to short rallies during a MACD downtrend and buy pullback during an uptrend. You may want to consider other variables such as price structure, multiple time frame considerations, and price action in conjunction with trading a simple cross. Once the MACD line crosses over the signal line to the downside, that would be bearish, and you could use that as a signal. Conversely, if the MACD line crosses to the upside, it would be bullish, and you can use that as a buy signal. And we talked about the fast line being approximately crossover of the MACD to take a trade. So I want to draw your attention to the black round circle at the top of the chart. Here's a pin bar, and it formed after a run-up in price. Also notice the separation in the MACD indicator as price approaches the region, in the same region of previous resistance that's not really seen on this chart. And it shows goes to the upside, but closes on its open as seen on the pin bar. This is bearish. Now bring your eyes to the fast line of the MACD, and you can see it hooked to the downside. Given the context of price action and structure, you could gain an early entry into a possible reversal. Depending on the context of the chart, you can use the fast line hook as a buy signal or a sell signal. These can be used in a weekly chart, and you would have entered 5 or 6 bars earlier, and you've been up over 120 pips before that breakdown happened. What about divergence? I'm not going to talk about divergence simply because this also takes into account price action and structure. And I find the normal teachings about divergence has way too many holes, because if you trade just the indicator, you're setting yourself up for a failure. Another way that we can use this indicator is to take advantage of the zero line and the fast line as a means of trade entry. Again, keep in mind the lagging nature of all indicators with this trading method, and highly consider using multiple time frames for your trading. You can see the change in trend when during the moving average crossover. So we know we're looking for a short trade. Once the fast line crosses the zero line, this could be a trade entry. You can see how mechanical this is, but it also gets you in very late in the move. The red line indicates where, if the weekly trend turns down, you would enter on the daily chart using the zero line cross. That black line is where you'd enter on the weekly chart 2 months later. So in summary, with the MACD, we do have a useful technical analysis tool. It has quite a few uses, and we talked about how to determine the trend using the 2-line cross, how to read momentum using the fast line, trade entry using a fast line hook, trade entry using a zero-line cross, the benefits of multiple time frame analysis. And as with all technical indicators, you want to test this as part of an overall trading plan. Also, be aware of the lag time using this indicator, although for some traders, it'll be an advantage as with any moving averages, consolidation plays, and the 2 lines of the MACD converge. When this happens, price is usually in a range, setting up a possible breakout trade. So test, back test, forward test, and you might just find the value of the MACD in your own trading process.
Now, the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between the instrument's 26 and 12-day EMA. Of the 2 moving averages that make up the MACD, the 12 EMA is obviously the faster one, while the 26 is slower. In the calculation of their values, both moving averages use the closing price of whatever period is measured. On the MACD chart, a 9-day EMA of that MACD line itself is plotted, and it acts as the trigger to buy and sell. The MACD generates a bullish signal when it crosses above its own 9-day EMA, or sends a sell signal when it moves below the 9-day EMA. So that's the crossover on the bottom of the chart. Now, the MACD histogram is simply an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA, and below when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerator. Remember, I was showing the peaks and the valleys, and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. Now, the MACD indicator is both a momentum oscillator and a price-based oscillator, and it works in almost all time frames. And a good way to use MACD is to use maybe a 15-minute chart and a 30-minute chart and compare the MACD crossovers to get support of your decision making. So remember, we have the MACD line, the signal line, and then the histogram. We want to keep an eye on that zero line. That is the important thing on that histogram. And we always want to be trading in the direction of, if we're positive and above the histogram, we only want to be thinking, no matter what you're looking at and how you're determining, a buy scenario. When it's minus or below the zero line, we only want to be thinking about a sell scenario. So MACD gives us three stories. It gives us moving average crossovers, it gives overbought and oversold conditions, and divergence. So MACD is a histogram. The MACD histogram is a four-step derivative from price action. The first derivative is the 12-period EMA and the 26-period EMA. Second derivative is the MACD line, which is the 12-day minus the 26. The third derivative is the MACD signal line, which is a 9-day EMA of the MACD line. And the fourth derivative is the histogram, which is the MACD less the signal line, which is plotted as the histogram. The base for this indicator is the securities price. It takes 4 steps to get to the actual price. While it may not be necessarily a bad thing, chartists should keep in mind when analyzing the MACD histogram, it's an indicator of an indicator. So let's take a look at how we would incorporate MACD into a very simple trading strategy or a filtration system that will help you make a good trading decision. Now, again, any indicators or any strategy you use still has to be dropped into your risk management tools and your risk management strategy. Simply getting a buy or sell decision, then you have to count from there. You have to then calculate entry points and exit points, target points, stop loss points, and then you have to put it into your risk management. Because if that target isn't far enough to cover your risk management, or that stop loss is too far beyond your risk management calculations, then you can't make that trade. Because what we're doing is we're trying to filter out every possible, not bad trade, every possible risky trade, and only end up with the best. Because the market offers you thousands of opportunities. So let's take a look at how we might combine MACD and a couple of indicators into a nice trading strategy that could be everything you need to make all of your trading decisions. So we're going to take a look at the top indicators. Now, if you notice on your screen, I put together a handout called the ETX Capital Technical Indicators Guide. Just click on the download button, you can download it. It's a good resource material, and it follows along the strategy, but it also talks about all of the top indicators, and it shows you how to use them and what to do with them. And we're going to now take a look at how to put them together in a strategy using MACD.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches the reverse, traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy
or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument, become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they're moving away from one another. When the short-term moving average is above the longer-term moving average, this area of the indicator will show average. This area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal. And when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of the trading system, but is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. It can be refined to the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one. It's indicator confluence, which means to use indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also let us come out of the market as far as the market rallying or going up is concerned. And we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. And also is more likely to reverse and the market to retrace back up the opposite direction of a trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market is hit the change red here before taking the short trade. And then we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Super Trend turning back to red. Indicator 1, RS.
Now, that's a nice little easy combination of 4 simple to use indicators.
Indicator 1.
And it's a great little system. Now, what I want to do is show you how to use the ETX charts to put these indicators on and how to put the indicators in MACD on the ETX chart. So when you go to the platform, you can do this very simply. So let me share with you our little presentation on putting MACD on your charts on the ETX Trader Pro advanced charts. So remember, on the ETX platform, you can have charts with white backgrounds or black backgrounds. You decide when you set up and customize your platform. If you're not sure how to do that, contact customer support. They'll give you step-by-step information about how and walk you through setting up and customizing your platform. But that was how you would actually use MACD and use your charts, because those are the charts you should be trading from. Now remember, with MACD, the biggest disadvantage of using this indicator to generate transactions is that a trader can get whipsawed in and out of a position several times before being able to capture a strong move in momentum. As you can see in this chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move. And this may cause a trader to realize small, unimpressive gains or even small losses during the rally. Remember, I told you, MACD doesn't tell you how far the momentum is going to carry that asset. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets. Another MACD drawback is its inability to make comparisons between different securities. The MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transactions that will help minimize the subjectivity involved in trading, and the crossovers, the signal line, make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this relatively simple indicator can be quickly incorporated into any short-term trading strategy. So remember, it's just like physics. Momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when that ball will stop climbing and change direction and descend. So just like in physics, momentum changes occur before the price of an asset changes. So to resolve the inconsistency between entry and exit, a trader can use the MACD histogram for both trade entry and exit signals. But remember, life happens. Trading is rarely black or white. So rules that traders agree on blindly, such as never adding to a loser, can successfully be broken, but we don't advise it. Now, MACD can give you a very simple tool to make you successful in the markets, or help you at least filter out the trades so that you only end up with the best trades possible. So thank you very much for joining us tonight. Please click on that little download button in the handouts and download the ETF's Capital Technical Indicators Guide so you have all this information at your fingertips. And thank you for supporting ETX, and we'll talk to you again real soon. Bye now.